the Chinese have been using freight futures for their container movements. And this is something I think which India can very closely look at, especially a lot of freight futures did not succeed in India because you didn't have a dollar base. To bring in liquidity, you need investors from overseas. And obviously, they're not going to go into rupees and, go into the problem of having Forex and stuff like that. So what F.I.C. actually does is it has two exchanges where you can list these futures. I'm not sure if all of you are aware of how freight futures work. So it's basically a paper document which is linked to the current freight rate, and you can actually trade this for future months. So you'll have the perception of what the market feels the next month freight would be for a particular route, and you can actually trade in it. So for the next 6 months, you actually have a paper trade that you can do and actually hedge yourself. So for example, if there's an exporter and he wants to export in December, you can actually go into the exchange, buy your December futures, lock in your freight by buying those papers. Because come December, if the rates have gone up, your papers are worth much more. You'll of course pay more on the physical, but your papers are worth much more. And if it has gone down, obviously you'll pay less on the freight and your papers would sort of even it out, and you would have hedged your risk. So I think freight futures, especially where the industry is currently, is something which is very relevant for this. And with NVOs coming in and with the increasing volumes, I know 20 million TEUs may just be sufficient to support. China obviously has 300 million TEUs, so much more liquidity. But even at 20 million, I think it's something which can be supported going forward.